What's up everybody, Gen X Dividend Investor here. In this video I drilled down into the nuances about if dividends increase your wealth, as there's more to it than you might realize, and I think you'll find this information really valuable. I'll also tell you about a well-known dividend ticker that just announced a split today. But before I continue on, I ask that you leave a comment telling me yes or no if you think dividends increase your wealth. Come on, pause the video and tell me what you think without researching it or reading other people's responses. Okay, and one last favor, please hit that thumbs up button, subscribe if you haven't yet, and click that bell notification, as all of that really helps support this video to be pushed out to more people. To begin with, a dividend typically comes in the form of a cash distribution that is paid from a company's earnings to its shareholders. That company has basically decided that instead of reinvesting all their cash into, or for their business, they are instead going to transfer value to their shareholders by means of a dividend. And when we talk about dividends, there are 4 dates you need to be aware of, and I need to elaborate on those dates so you can better understand the dividends and wealth discussion. The first date is called the declaration date, which is the date on which the board of directors announces and approves the payment of a dividend. That also means that a company's board could vote to not pay a dividend if they wanted, which would obviously have ramifications in the market. Okay, the next date to be aware of is the ex-dividend date, and that's the date where a stock begins trading ex-dividend or without dividend, which means that if you purchase the stock on or after this date, you'll not be entitled to receive the upcoming dividend. Thus, to qualify for the next dividend, you must have purchased the stock before the ex-dividend date. It's also good to understand that the company does not set the ex-dividend date, but instead it's set by the stock exchange where the company's stock is traded. The ex-dividend date is usually 1 business day before the next important date to be aware of, called the record date or record date. The record date is the date on which the investor must be on the company's books as a shareholder in order to receive the dividend. The ex-dividend date is earlier than the record date due to the fact that there's a settlement period for stock trades on exchanges, which should now be 1 business day after the trade date, at least in the US, and is abbreviated as T+1 or Trade plus 1 business day. Settlement is the process of completing a stock transaction where the buyer receives the purchased security and the seller receives payment for that security. Essentially, it's the final step in a trade, ensuring that the exchange of assets and funds is fully completed. Like if you buy J&J shares on Friday, your broker will debit your account for the total cost immediately after your order is fulfilled. Then your status as a shareholder of J&J will not be settled in the company's books until the following Monday, at which point you become an official shareholder, as weekends and public holidays aren't included. Okay, and then finally we come to my favorite date, which is the 4th date you need to be aware of, and that's the payment date, i.e. when all eligible dividend shareholders should get paid their dividend. Let's look at Coca-Cola to see these dates in action. I have 1,666 shares of KO stock, and Coke is my 15th largest position by market value of the 28 tickers I own, and I have about 119 grand of it. A couple months ago on July 29th, Coca-Cola did this press release about their next dividend payment. It says, "The company declared a regular quarterly dividend of 48.5 cents per common share, payable October 1st to share owners of record of the company as of close of business September 13. So KO's declaration date, aka the date they declared their next dividend, was on July 29th, and the record date was September 13th, and the pay date will be on October 1st. Since I know that the ex-dividend date is usually 1 business day before the record date, then I can surmise that the ex-date would have been on September 12th. I can verify that by checking the web, and one helpful site I like to use is called streetinsider.com. It confirms that the October 1st pay date for Coca-Cola that was declared on July 29th with the record date of September 13th indeed has an ex-date of September 12th. Another useful thing about Street Insider is that I can visually tell when and how much dividend hikes have been over the years for various stocks. Like here it says that Coke did a 5.4% dividend hike that was declared in February of this year, and in 2023 they did a 4.5% hike, and in 2022 they did a 4.8% one, etc. Okay, back to the X date for Coke. So that means that if you wanted to lock in the October 1st KO dividend payment, then you would have had to have purchased your KO shares before the September 12th X date. Sidebar, in my experience with Fidelity, I've noticed that my dividends are usually withdrawable in the evening on the pay date at around 9 p.m. Pacific, even though it shows up in a processing state in the activity log before that time, sometimes even days earlier depending on weekend and holiday timing. I have my taxable account configured to automatically transfer all cash dividends directly to my bank checking account, and then I have to manually transfer my retirement account divvies. Okay, so I've got my 1,666 shares of KO, and that dividend release article says that it pays out 48.5 cents per share per quarter. That means 1,666 times 0.485 equals $801.01 of cash dividends being paid to me every 3 months, which is equal to about $3,232 a year. And stick with me, as all of this information will help you understand about dividends in your wealth. So when companies sell their products and services, they make money, aka revenue. They pay some expenses to generate that revenue, and they end up with a profit. Dividends generally are just cash distributions of a company's profits or reserves, called retained earnings, which they transfer to their shareholders. Dividends aren't considered an operating expense and thus aren't included in the company's income statement. Instead, they're found on the balance sheet listed in the shareholders' equity section. Note, a company can also choose to distribute shares of their stock as a dividend payment rather than cash, but that's rare to do. The reason some companies may prefer to pay dividends in stock rather than cash is to protect their cash reserves. But before I talk about that, let's cover a similar but separate action companies can do, which is issue new shares to raise money instead of taking on debt, as there's no obligation to pay interest on new shares that are issued. For example, let's say a company has 10 million shares outstanding at $50 a share, which means they have a $500 million market cap. They decide to raise some money to fund a new project, so they issue 1 million new shares. Of course, the more shares that exist, the less each share represents the company, so each share would be worth a tiny bit less than when they were less shares. Companies issue shares to the public typically through a process known as a secondary offering, and this isn't a stock dividend. If they successfully sell those new million shares at $50 per share, then they'll raise $50 million to do whatever they want, like pay down debt or use in projects or acquire companies or whatever. At that point, they would have 11 million shares outstanding, and if the market didn't materially impact their stock price, they would be worth $550 million. Of course, when companies issue shares, it's a bit like a reverse buyback, and generally the market tends to apply downward pressure on stock prices since there are now more shares of the company out there. And when companies issue those new shares, they don't simply sell them on the open market in the same way an individual investor would. Instead, the shares are often sold through an underwriting process, typically led by investment banks. The underwriters purchase the shares from a company at a discount and then sell them to institutional investors or the public. So companies sometimes issue shares, which increase shares outstanding, in order to raise funds for new projects or acquisitions or whatever, instead of taking on debt, as there's no obligation to pay interest on new shares you issue. Okay, now let's go back to understanding what happens when a company decides to issue a stock dividend instead of a cash dividend, as that will help answer one facet about dividends and wealth. Let's say you own 100 shares of a stock and your company issues a 10% stock dividend, you would then hold 110 shares. However, the price of each share should adjust downward proportionally to keep the overall market capitalization unchanged. Thus, the total number of outstanding shares got increased, but the value of the total investment remains the same. So if a stock is trading at $100 and the company issues a 10% stock dividend, the stock price would automatically drop to $90.91, i.e. 100 divided by 1.1, at the open on the ex-dividend date to reflect the increase in number of shares. Either way, the market cap remains the same. If that company had 10,000 shares outstanding before it issued the stock dividend and its share price was at $100, its market cap would be 10,000 times 100, which equals $1 million. If you owned 100 shares of it before the stock dividend, that means you owned 100 divided by 10,000 shares outstanding, which means you own 1% of the company, and your 100 shares were worth 100 shares times $100 per share, which equals $10,000. After the 10% stock dividend, you'd have 100 times 1.1 shares, which equals 110 shares, and the company would have 10,000 times 1.1 shares outstanding, which equals 11,000 shares, all of which would be priced at $100 divided by 1.1, which equals $90.91 at the open on the ex-dividend date, to reflect the increase in the number of shares. But you would still own the same portfolio value, i.e. 110 shares times 90.91 equals about $10,000 worth. Thus, before the stock dividend you own 1% of the company, and after the stock dividend you own 1% of the company, and before it had a market cap of $1 million, and after the dividend it had a market cap of $1 million, and before your shares were worth 10 grand, and after they were worth 10 grand. So your net worth didn't change any just because you got a stock dividend. However, one thing that can change is earnings per share. Basically, stock dividends can reduce the EPS if the company's net income doesn't increase proportionally with the number of shares. Remember, the formula for earnings per share is net income minus preferred dividends divided by weighted average common shares outstanding. Or to simplify things, we'll say EPS equals income divided by shares outstanding. EPS essentially just means how much profit is attributed to each individual share of stock, and so you want to see your EPS going up, and EPS often acts like a magnet which draws share prices after it. Okay, so in our example, before we did the stock dividend, let's assume the company had a net income of $15,000. Its EPS would have been 15,000 divided by 10,000 shares, which equals $1.50. So it's 10,000 shares are each earning $1.50, which makes sense since 10K times 1.5 equals 15,000 in income. And then after the stock dividend is issued, we're still making 15,000 in net income, but now our number of shares outstanding has increased to 11,000, so now EPS is lowered to 15,000 divided by 11,000, which equals 1.3636. Thus, like you'd guess, as more shares exist, then earnings per share goes down, which is why issuing stock dividends can reduce the earnings per share of existing shares. But you also have to realize that if you had a pizza and you cut it into 10 slices instead of 5, each slice gets smaller, but it's still the same pizza. And it's the same deal with EPS. More slices or shares, but the same earnings, so you gotta factor that into how you might be using the EPS metric. It's kinda like stock splits. They aren't changing the actual value of the company or your investment, it's just changing the way things are divided up. Like when a company does a 2-for-1 stock split, each shareholder receives an additional share for every share they already own. This means that the number of shares owned doubles, while the price per share is cut in half. So the amount of the company you own remains the same, even though you now have twice as many shares. That being said, it is pretty common for stock prices to go up when splits that increase the number of shares are announced, and conversely to go down when reverse splits happen. Basically what's happening is that market psychology of shares seeming to be cheaper can apply some upward pressure on a stock, even though each share you buy is now buying 1/2 or whatever as much as it used to. And speaking of splits, a well-known dividend ETF I own called SCHD today announced a 3-for-1 stock split. I have 2,668.6 shares right now before the split, which means I'll have 8,005.8 shares afterwards. SCHD trades for $83.35 before the split on the day I'm doing this, so it'll probably be around $27 or $28 after the split, which is scheduled to happen on October 10th. And I wouldn't be surprised if we see more upward pressure on the stock price, as some people suddenly feel like they can buy more shares of it. But I also wouldn't be surprised if it goes down, as that's the market. Now, there was a time in history where you couldn't easily buy fractional shares, so there was more merit to stock splits allowing more investors to get in with less available cash. But with fractional buying, it made doing splits kind of moot, other than the psychological aspect. And sure, there's more to it, like maybe the company's trying to make their stock more liquid, or maybe management is doing it to boost investor confidence by signaling that they'll have strong growth and they want to keep their price down, or whatever. Okay, now with all that understood, let's do an example of what happens when a cash dividend pays out, which will help answer the question of if dividends increase your wealth. Let's start with the example of you owning 100 shares of a company that has 10,000 shares outstanding at a price of $100 with its market cap of $1 million, and that makes 15 grand in net income. This company sells some product in the market and people buy it, and let's say its revenues or gross sales go up. Revenues are listed on the top of the income statement, also known as the profit and loss statement, so that when you hear about top line growth, it means the company is experiencing an increase in sales or revenues. If you look to the bottom of the income statement, you can see the company's net income section. When someone talks about bottom line growth, it means the company is seeing an increase in profits relative to how it did previously. Okay, let's pretend our company was paying out a dividend of 18.75 cents per share per quarter, or 75 cents per share per year. That means each year it'd be paying out 0.75 times 10,000 shares, which equals $7,500 in cash divvies, which is $1,875 per quarter, assuming they paid quarterly. This company's dividend payout ratio would be its dividends paid out in a year divided by its net income, which would be $7,500 divided by 15,000, which equals a 50% payout ratio. Every quarter, this corporation would be losing, aka transferring, $1,875 of value off its balance sheet to its shareholders. And the date that happens on is the X date. Specifically, what would occur is that their $100 stock price would get lowered at market open by the amount of their divvy per share that is being paid out, which in this case is 18.75 cents, which means the opening price of the stock on the ex-dividend date would be about $99.81. Of course, keep in mind that actual market conditions, investor sentiment, and other factors can influence the stock price on that day, so it could close higher or lower or whatever, and often the lower a good dividend stock goes, the more influence there is to jump in because people see its dividend yield going up. Anyway, they lowered the stock price on the X date to reflect the reality that the overall worth of the company got lowered by the amount that was paid out by the divvy. The market cap in our example company before the divvy was 10,000 shares times $100 per share, which equals $1 million. But after the divvy, the market cap is 10,000 times 99.8125, which equals $998,125 because $1,875 of value was transferred or lost via the divvy payment. That means mathematically, your dividend didn't increase your net worth. I mean, before you had 100% of your net worth wrapped up in stocks, and afterwards you had a small percentage of your net worth in cash and the rest in its stock, leaving you with the same amount overall. Your asset portfolio composition has changed, but your total worth is the same, at least at that very moment. And before your portfolio was 100 shares at $100 each, which equals $10,000 worth, and after you'd have 100 shares at 99.8125, which equals $9,981.25 worth of stock, but you would also have that cash dividend of 100 shares times 0.1875 per share per quarter, which equals $18.75, for a total portfolio value again of $10,000 worth. But now things get more interesting. Let's say you reinvest your cash dividend you just got. Let's also assume that you're holding it in a retirement account so that we don't have to deal with possible tax implications. So you take your $18.75 cash dividend and you buy a bit of fractional shares of the company that just paid you. We'll pretend that the stock price remained at 99.8125 when you bought it, which means you got about 0.188 more fractional shares of it. Thus, now you'd own 100.188 shares of the company. And since they didn't issue more shares for your dividend, but instead you just bought more shares on the open market using the cash you got, that means you now own a larger percentage of the company. The cash dividend, coupled with reinvestment, allowed you to buy more of the company, though the overall value of the company went down by the amount of the dividend they paid out. Or to think of that another way, the company had 10,000 shares outstanding before and after they paid out their cash dividend, and before you owned 1% of the company at 100 shares, and then after you reinvested you owned 100.188 shares, which means you'd own about 1.0019% of the company. Thus, the takeaway is that while the cash dividend didn't increase your net worth in the moment, it did transfer cash out of the control of the company and put it in your pocket, and if you reinvest it, then you end up owning more of the company, allowing you to enjoy even more of its growth in the future, assuming it grows. And when you have your drip on it in a retirement account, it's kind of a magic way to continually increase your ownership in a company, which can then compound the rate of your net worth growing, assuming the stock is still appreciating. So in that way, dividends can increase your net worth, or rather, they can act as an accelerant to stock appreciation growth. Now, the naysayers would say that you can do the same thing with non-dividend stocks by selling shares or fractional amount of shares, and doing that gives you full control of when you get cash and when you might have taxes. And there is some truth to that, but you also got to realize that when you sell shares, your ownership in the company is going down. And then the naysayers might say, sure, but you're still taking a forced stock price reduction to get that dividend cash out, and that's also a valid point. I mean, you own a greater percentage if you reinvest, but you own a greater percentage of something that is worth a bit less, so is that really anything to write home about? Well, that partially depends on what the company does from here. I mean, reinvesting a dividend of a sinking company probably isn't going to work out too well. But reinvesting into good assets usually does work out, and that's why I say the quality is where you gotta focus. One probably good idea might be take some of your divvies and reinvest them into VTI. I mean, VTI is as sure of a long-term stock plays I can think of. What would be really cool is if you had a large enough portfolio such that 100% of your expenses could be covered by VTI's dividends. Anyway, dividends aren't free money, and I did an entire video explaining why that is, but they are the main way that companies directly return money to their shareholders, and as I've tried to elaborate, there's some nuance about how they impact your wealth. In my opinion, they're a great way to have a passive cash flow income stream, and they're an awesome way you can maintain and even grow your ownership percentage in a company, all without selling shares. I know, and have experienced firsthand, that the longer you reinvest good dividends, that your wealth does indeed compound and snowball. But underpinning that growth is that your assets also need to grow, which is why I keep pounding the table on owning quality assets. Dividends can increase your wealth through reinvesting them over time, and that cycle can continue if your company is growing. But if the company dries up, then obviously your dividends dry up. A company that is prospering and growing is basically a cash-generating machine, and that's why people often value a company using a discounted cash flow analysis, or DCF. A DCF estimates a company's value by projecting and discounting its future cash flows. It's based on the idea that a business's value is determined by its ability to generate cash for its investors. Money today is worth more than money tomorrow due to factors like inflation and risk, so we need to adjust future cash flows to reflect their value today. So DCFs can help investors know whether a company is overvalued or undervalued compared to its current market price, and if the DCF value is higher than the stock's market price, the stock might be a good buy. And doing DCFs is only one aspect of figuring out if you should invest in a stock. It also depends on the management of the company, its moat, how defensible that moat is, etc., all of which should influence whether you decide to invest in something. Buffett once commented on valuing a company and was talking about how people say that one in the hand is worth two in the bush, and that for him the real question was how many birds are in the bush, when can you get them out, and how sure are you that you'll get them. That's kind of like saying how much cash is the company generating, when can you get that cash, and how sure are you that you'll get that cash out. If you can figure those things out and have some reasonable level of confidence in it, then you're more likely to invest in something. And sometimes when I mention Buffett, I'll invariably get someone who'll comment that Buffett doesn't even like dividends, which is why Berkshire doesn't pay them. So let me clearly and concisely refute that. If you read Berkshire's 2012 shareholder letter that Buffett wrote, he said, and I quote, "A number of Berkshire shareholders, including some of my good friends, would like Berkshire to pay a cash dividend. It puzzles them that we relish the dividends we receive from most of the stocks that Berkshire owns, but pay out nothing ourselves. So let's examine when dividends do and don't make sense for shareholders. Most companies pay consistent dividends, generally trying to increase them annually and cutting them very reluctantly. Our Big Four portfolio companies follow this sensible and understandable approach, and in certain cases also repurchase shares quite aggressively. We applaud their actions and hope they continue on their present paths. We like increased dividends, and we love repurchases at appropriate prices," end quote. So Buffett relishes dividends that he receives from most of the stocks Berkshire owns. He likes seeing increased dividends. Thus, clearly people are incorrect if they think Buffett doesn't like dividends. Buffett has also said that Berkshire doesn't pay a dividend right now because, in essence, he and his managers are good at investing the cash that their business generates, and their shareholders want them to continue doing that. But he's also said that the day will come when Berkshire will pay a dividend, and you can watch a video I did called "Why Berkshire Hathaway Will Eventually Pay Dividends" if you want more context to that. Anyway, to get philosophical for a moment, let's think about what wealth actually is and what it means. Like we only get one life to live, and a key point of growing wealth is to give us more financial freedom, either now or in the future. For me personally, having passive dividend cash flowing into my pocket has increased my financial freedom, which is why and how I retired early once my dividends grew larger than my family's expenses. But the wealth I'm getting from my quality divvies goes beyond just monetary aspects and ventures into them also increasing my mental health or wealth. Seeing that money flow into my accounts without me doing anything still amazes me, and I'm almost exactly at the 4-year mark of being retired due to divvies, and my conviction and love for them has only increased. Some people will diminish the psychological benefits of divvies, but hey, I'm human, and it's okay if someone else doesn't value what I value. Okay, now let me share some more perspectives to consider about dividends increasing one's wealth. Chuck Carnival, one of the co-founders of FastGraphs, along with a many-decade investor, published 2 articles on Seeking Alpha I recommend you read. The first is called Dividends Provide a Return Bonus, and Chuck finds that if you examine 2 companies with equivalent rates of earnings growth, and where one pays a dividend and the other does not, the dividend payer will provide their shareholders a higher total return. He says that both stocks will provide equivalent capital appreciation when measured over a time period when the market is behaving rationally, but that the stock that pays a dividend to its shareholders is providing them an additional return bonus, and he includes evidence to back up his point. Another article he wrote you gotta check out is called The Unbridled Truth About Dividend Contribution to Shareholder Profitability, and he provides evidence as to why it's inaccurate and even preposterous to say that dividends are meaningless to your net worth. And then there's some great articles from a guy named Tom Armistead, where he's done a ton of work backtesting the performance of portfolios involving various investing strategies, and he found that there's an excess return associated with owning dividend payers over the long term. Specifically, check out Backtesting a Portfolio of Low Beta High Quality Dividend Pairs, and another called Backtesting Dividend Growth versus Dividend Yield. I'll include links to all those articles in the description of this video, and the reason I'm an affiliate for Seeking Alpha is for articles like those, as well as for comments investors add to the articles. Seeking Alpha has a discount that is currently running when I wrote this, so use my link in the description of the video to potentially get some cheaper prices. Beyond those articles, I've previously shown you data from multiple studies, such as Hartford Funds' analysis, which backtested dividend stocks and non-dividend stocks, and they showed how, historically speaking, dividend-paying stocks have outperformed non-dividend-paying stocks on average. So do divvies increase your wealth? I'll let you be the final arbiter of that, though I'll tell you that the IRS seems to think so, as they see dividends flowing into your pocket as new wealth that is taxable income. Another comment I sometimes see is by people who say that if I love dividend income so much, then why don't I just get treasury bonds instead, as they generate even more reliable income. And sure, US Treasury bonds are considered one of the safest investments out there because they're backed by the US government and investors are almost certain to get their principal and interest payments on time, which is appealing for those who prioritize security over higher returns. And the interest from Treasury bonds can be exempt from state and local taxes, though it is subject to federal taxes, all of which makes them particularly attractive for investors in states with high taxes. But good dividend-paying stocks often yield higher returns than Treasury bonds, especially in low-interest rate environments. I mean, we tend to see both capital appreciation and dividend income. Treasury bonds, on the other hand, return only the principal with interest and don't grow in value over time. That can also mean that if inflation rises, the fixed interest rate from bonds may not keep up with the increased cost of living. In contrast, good dividend-paying companies often increase their dividends over time, usually outpacing inflation. Plus, us dividend investors can reinvest dividends to buy even more shares, potentially benefiting from compounding growth over the long term, whereas Treasury bonds don't offer that growth potential. And of course, the more shares we own, the more divvy income we tend to get. So in summary, Treasury bonds are excellent for safety and stable income, but may not provide the returns or even inflation protection that some investors want. I prefer how dividend-paying stocks offer higher potential income and growth, but come with greater risk and volatility. The choice depends on your risk tolerance, income needs, and whether you're looking for more safety or for more growth and more income potential. And a similar response is that bonds historically have at a much lower return than stocks, so while they can have a role in a portfolio, I prefer to go with quality blue chip dividend stocks. But that's just me. And with that, I'll ask that if you got any value in this video, then I'd really appreciate it if you hit that thumbs up button, subscribe if you haven't yet, and click that bell notification, as all of that really helps my videos. Okay, now I'd like to do some shoutouts to my newest Patreon Aristocrat and King signups. The first one goes out to Just Deuces, who recently signed up as a Patreon Aristocrat for an entire year. The next shoutout goes to DZDivZ32, who also signed up as a Patreon Aristocrat for a full year. And the final new Aristocrat shoutout is to Michael, who just signed up. I also have a big shoutout to Dustin, who just signed up for a full year as a Patreon King, which gives him everything Patreon champions and Aristocrats get, plus he can chat privately with me voice over my Dividend Discord for 30 minutes each month that he remains a King. I'm not a professional, but I'm happy to chat about whatever folks want. Now I'd like to recommend that everyone check out my FastGraphs affiliate link along with my coupon code in the description of this video, as using both should allow new users to get 25% off their first payment, even if they sign up for a full year. I'll also recommend that you try out my Seeking Alpha affiliate link, as new users can often get good discounts for signing up. Plus, take a look at my Patreon seats to see if there's something you want to sign up for. But since my Patreon Aristocrat and King seats are usually sold out, I'll also recommend that you join my channel membership, which gives you a variety of perks you probably like. And don't forget to join my free Dividend Discord chat server, which has over 11,000 dividend investors on it from 83 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor, and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.